September swoon or not, the market continues to be a locomotive blasting through September. I called for a 5 to 8% pullback in the month. As of this recording, the market's off 4%. To me, this is just a consolidation dip, a rotation of investment dollars from high-flying tech stocks to more value-based plays, but the money is still in the market. This is just a slight dip, which I hope you're able to take advantage of. I'll tell you why there's reason to be optimistic about October and why this October in particular will make or break the final leg of the year. October traditionally represents the ramp up to the Christmas spending season. You've probably heard of the so-called Santa Claus rally. This year we've got a debt ceiling showdown, and how can we trust these politicians to not mess this up? Everything comes down to timelines. These politicians aren't thinking about the short and medium term impacts of letting the debt ceiling go unaddressed. They'd rather engage in brinksmanship, a game of chicken, the oldest game in the book. And the debt ceiling is probably the single biggest thing I'm worried about. It's the one hurdle that can catch this market by its shoelaces. And if a government shutdown drags on for days or weeks, that 8% correction we didn't see in September will be firmly in place before Halloween. But on the bright side, I expect the market to march higher from Halloween till New Year's. It statistically tends to do that. Why should this year be any different? I think what matters most is where the S&P is at on Halloween, because I see the S&P rising 7% between Halloween and New Year's Eve. And if I'm right, better believe I'm making a follow-up video to brag about it. And if I'm wrong, well, we can just sweep that under the rug just a little bit. But I think 7% is fair. When you consider the top 20% of the S&P are the big tech powerhouses, do we think big tech couldn't drag the rest of the index up with them? You don't think Amazon is going to have a stellar Christmas, or Google with the ad revenue orbiting all these consumers? Remember, we have a worker shortage currently. People are choosing higher wages, so they've got more money in their pockets, and they'll elect to spend it. I'm betting on it. Anyway, get serious for a minute. The three big things that have happened in the past Octobers: the crash of 29, Black Monday of 87, and a chunk of the 08's financial crisis. They call this the October effect, the psychology of expecting big drops in the market during the 10th month. October is, on average, the most volatile month of the year as well. Let me just emphasize that not all stocks perform the same, and not all sectors perform the same, but we should take a lesson from the past. Take a lesson from these buying opportunities. From 2019 in particular, there was a kind of once-in-a-decade correction for software stocks, October of 2019. IGV as a whole is up 30% annually for 5 years. That's the iShares software ETF. I often reflect on that 2019 correction. In real time, I was thinking, maybe there's this software's final day, the beginnings of valuations coming down. But looking back, I should have loaded up even more. Software doesn't drop 10%. In IGV, the software ETF from iShares with $5 billion in assets has nearly doubled since that October 2019 correction. We had a similar market-wide correction in October just of 2020. They say that one mushroomed after SoftBank got greedy with derivatives to bet on US tech stocks. Not all that different from Archegos 6 months later. When big money managers get sloppy with leverage, the system shakes a little bit. So there's this history of bad news coming out on paper during previous Octobers, but the market typically carries higher into a Santa Claus rally. So what I'll be doing with any sort of volatility leading into November is to take a really big gulp and hit the buy button. Trust your thesis, trust your long-term outlook on the market. Stop thinking about volatility and start thinking about sale prices. I'm Skylar James. Thank you for watching, and I'll see you on the next one.